Well, guys, we flipped early, didn't we? Something happened with the switcher. Tonight, is it a August heat wave or is it an August melt up? Just crazy times in the market. Here we are at lifetime highs of the S&P 500 and the Russell, and there's just no way to predict what's going to happen next. And this is the second slowest month of the year. So go figure on that. And the Strait of Hormuz just can't seem to get cleaned up. When will it finally affect the stock market? Well, it's not happening anytime soon. And Kevin Warsh, as the Fed chairman, well, Trump brought him in to lower rates, and it looks like he's going to raise them, and that's not going to make the markets happy at all. From Chicago, it's Thursday, August 13th. I'm Charles Brown, your portfolio manager, and this is CB3 Live. Glad to see all you guys tonight, and we always just kind of come to expect something just might happen with the electronics, right? It happens at the network level. Why wouldn't it happen on my show as well? At any rate, we're glad you're here. We got a lot to talk about. It's a busy, busy August, again, with the market at lifetime highs in the middle of just geopolitical chaos. Doesn't seem to make sense at all. Is it an August heat wave or is it an August melt up? I really don't know, but I can tell you what, the markets are hot, and that's why I've got that fire extinguisher. So the August melt up, we're at new highs and new targets from major rating agencies on further highs in the second slowest month of the year. The segments tonight, the melt up, macro and geopolitical news, economic data, the Iran peace deal that isn't, and of course, updates on our programs. So we have a new word of the day, what for ya? This is my own coin of a word, okay? The synoptic is the shrug rally, unexplained strength, melt up, mystery. It's a combination of what and phoria from the Greek euphorius, bearing well, and euphoria, of course, we know what that is. But what phoria means, so why is this happening? What phoria is causing this craziness, all right? We're going to find out as we go through this. So what is a melt up? Well, it's different than I don't know, a patty melt or anything, but the melt up this time is being caused by AI. So the AI trade is roaring back, 15% up for the SOX Semi Index. This is not the Chicago White Sox. They are doing anything but roaring for those of you here in Chicagoland. Since July 29, strongest 4 6-day rallies since 2020. Read this next one carefully. NVIDIA in 1 week added $562 billion in market cap, the largest any company has ever added. It took Procter and Gamble how long? 110 years to get to 400 billion, and NVIDIA added that in a week. If you don't think that big tech is running the roost on all of the market moves, and that's of course why we made our changes that we talked to you about last month, that is good evidence right there. NVIDIA over $500 billion move in a week, and Apple down in the same week. So it's not being spread all the love equally among the Magnificent Seven. So remember July, tech was the worst sector, and now it's back to being the best. That's what a melt up looks like from the inside. Violent rotations from different asset classes, different sectors, huge dollar moves, the yen at a 30-year low, and the fear of being left out. That is FOMO, and that's what causes things to move. And some of this is due to the fact that these huge companies are just borrowing, and they must have credit card limits at Goldman Sachs, because Look at this, 114 billion, Amazon 108, Meta, Oracle. This is what they've raised since 2025. So just a trailing year. There are most of the stocks in the S&P 500 that don't have a market cap of 114 billion. And that is exactly what Alphabet has borrowed. What does it look like on the chart? So this is Alphabet borrowing, and I don't know if they ran out of money at the Treasury, but they're not only borrowing money in US dollars, but euros, Canadian dollars, Swiss francs, British pounds, and the yen. All right, Alphabet and Amazon just on a rage of spending here because it's all about keeping up with what the competitors are doing in the data space area. And I don't know if this is because they suspect that Elon Musk is probably going to be the first one to put data centers in outer space, but here on the planet Earth, they're building them like crazy, and that's what's causing these huge spending sprees. So, as you would expect, then the performance in the markets is narrowing and narrowing. All right, the SOX I mentioned earlier, that's the semiconductor index, is up 15%, but the equal weight S&P is up less than 2%. That's like those companies, S&P that I mentioned earlier, Procter & Gamble, Johnson & Johnson, sort of the snore names anymore, because they just don't have the median weight to move the index like these big stocks do. And that's, again, why we tuned up our portfolios over the last couple months to capture these moves. On the right-hand side, look at that, 38% of the S&P 500 are just 10 stocks. 37% of that is just tech. In the QQQ, 66% are the top 10 stocks, and SpaceX alone is more than 4% of the entire index, and it's only been trading a few weeks. There's just no precedent for this in US history, but we can't just stand by. We have to jump on these wagons and, of course, protect ourselves to the downside, which we talk about throughout these shows, but we'll cover it again at the end of this program too. The record is real, though. The foundation is a dozen names and an oil headline. That is what's moving the market today. So this melt up, said out loud, these are various companies projecting where they think the market's going to end. Today, the market hit an intraday high of 78.16. It closed right around 78.02, still a lifetime high. Goldman Sachs says 8,000 by the end of the year. Yardeni at 82.50, and Evercore 9,000 in the S&P 500. Now, if you guys remember from all these years you've been watching me, this is the second worst year. That's the third time I've said it now, but it's important to realize that because we have a huge market move underway in the second worst month. All right, while we still have uncertainty at the Fed for sure, and uncertainty in the Strait of Hormuz. This is just unprecedented. And if we can make it through September, which is the worst month of the year, then October, November, December are traditionally the fourth quarter of the year, the strongest months of the year, November especially. So it'll be real interesting to see if somehow we can get this settled with some kind of deal in Iran with the Trump administration. We could absolutely see that 9,000 target, and I would love to see that, and I bet you would as well. So how do we trade this melt up? Well, we ride it. We just keep the pedal to the metal. We pre-plan our exits, so we have stops in place in every single asset, which you guys know, and we hedge what we call tail risk. That's when the market goes down on the left tail. The right tail, we don't care. It can go limit up all at once. But on the left side, we are protecting against a downside move. We have option spreading, which we've talked about extensively over the last year. We plan our exits, no guessing, no theory, just discipline in advance. So what has the market done? 78.16 intraday high, traded up to 78.06, paused, and then gapped up to 78.16. And it's a long way from Friday's close, okay, which itself was the 26th market high of the year. So $2.5 trillion in market value has been added in the 5 sessions of this month, all right, or 6 or 7, whatever it is. That count, I'm not sure if that count is right, actually. But the AI trade came roaring back, and that's what things moved up so strong today. NASDAQ itself up 1.3%. Still, though, the NASDAQ is shy of its May record. So why is that? That's because in July, things were really beaten down and other sectors rose. And that's what we want to see. So we don't just invest in technology or communication services or even consumer discretionary. We invest in financials. We invest in several sectors, not all of them, because some of them, frankly, will never see growth again unless these huge trillion-dollar companies just fall out of existence because they just simply can't keep up. So we're going for the growth sectors, certainly in DS, and then a blend in our ETFs in MP. We'll talk about more of that at the end of the program. So at CB3, a record is exactly the moment to slow down and ask what's holding this up. And that's what our show is about tonight. What is holding up this melt up? Well, we have a really strong earnings season. So last month we had about 128 stocks reporting. Now we have 436. So just so you know, it's always between the first show of the quarter, or the first show of the quarter and the last, and now we have almost everything in. So when we come back to you in September, there'll hardly be anything there. So most of the earnings reported are between the first and second show of every quarter. And that's what's happened here. So 85% are beating their EPS, earnings per share, estimates versus the 78% 5-year average. Now, I've quoted 73% over a 3-year average look back. But if you look back 5 years, 78%, and we're at 85%, the blended earning per share growth year over year, 50%, which is astounding. However, there's an asterisk on that, and that's because it's flattered by one-off investment gains. So just because you actually book a non-cash gain doesn't mean that that's actually you're selling more widgets. So you have to discount that a little bit, but not that much. The reality is that through everything we are going through right now, just chaos with this war and the administration not looking good in it, just frankly, it's just not looking good. But despite that, because of earnings, the market continues to move higher because when it comes down to it, I'm going to come back on camera. It's all about what? Everybody say to yourself, 2 things, interest rates and earnings. Interest rates and earnings, that is what drives the market. At any given time, a plague can break out in 2020 like COVID, all right, and temporarily derail the market, which it did for just a few months. All right, we had a financial meltdown in 2008, and that derailed it, but not for more than 2 years, which at the time, of course, felt pretty bad. But the reality is earnings and interest rates are what drive performance, all right? Healthcare is the lone sector with an earnings decline, and yet it even did pretty well. Where are we seeing these beats in projections? 98% of healthcare companies beat their forecast. Technology, 94%. Energy, industrials, financials round out the leaders. It's just a really good time, a really good quarter. Now, keep in mind, we are reporting the second quarter. We're in the first quarter. Right now, let's try this again. I get this mixed up here. We are reporting here in August on second quarter, as we are in the third quarter. When we come back for the October report, we will be showing the third quarter. Say that real fast, especially when your switcher brings you on the air, 30 seconds before you're supposed to be. All right, guys, that's where it is, though. We are seeing a lot of beats, and it's what we want to see. The $1 trillion club expands again. NVIDIA now is at $5.3 trillion. There are only 4 economies in the entire world that exceed $5.3 trillion. Apple right behind it, Google, Microsoft, and Micron getting ready to join the club, probably will be there next month. And this is the reason, in green, underlined at the bottom, why DS and MP took over the slots of managing money for you, because they are structured to capture a bigger share of these huge $1 trillion companies. And that's what we need to do to keep up with the indexes. It's just necessary. SpaceX has made a round trip. They opened at 135. They traded to 225, 3 days into trading, all the way down to 108, closed today at around 142. We're a hold on this in DS. We think that it's only a 2% holding, but if we trade back above the initial, I don't know about the IPO at 135, but what we're actually targeting is a Goldman Sachs target price of 160. So I could see us at that point not selling, but actually adding another percent. Watch what happens. We'll talk about this on the September and then on the October show. But this stock is positioned to just absolutely run over the market because of the battery capacity. So SpaceX is obviously about space exploration. But I think, again, that Elon Musk wants to take the potential of having data centers in space. And there's no one else on the planet that can make that happen. He's obviously not going to be talking about it until it's really close to reality. But we want to be part of that ride. To me, this is like being there on Amazon or with Amazon in the very early days. What's happening macro and geopolitical? Let me look at questions here. What do we got? Hey, Tom Milestone from Tennessee. How you guys doing? Great to see you, or at least hear you online here. Keith, what's going on? Maybe the Strait of Bermuda will open the same day when they raise rates and cancel. Yeah, wouldn't that be something? You guys feel free to type in the chat box. I do take live questions. There's about a 25-second delay. So anyway, type your questions in, and greetings from Tennessee. You guys are about to have a beautiful autumn down there on the eastern side of Tennessee. U.S. policy, as you know, policy makes what we have to live with in this country. We all hate politics, but policy affects us personally and at the portfolio level. All right. And that guy right there in the middle is a big part of that. So the piece that isn't: 2 deals, 0 signatures. 2 deals, 0 signatures. It's all elephant talk. You know what elephants do when they talk? They make a lot of noise and don't say much. And that's exactly what's happened here. June 17th, signed a deal. July 7th, the IRGC starts striking vessels again. August 7th, Iran and Oman announced a shipping corridor agreement. Now, 2 to 4 months later, they're just barely creeping through. I just don't understand why we can't go in there and just clean out this. It's just not that much territory, and we have the most powerful Navy in the world. There must be something we're all missing, and the newscasters are befuddled as well. This should not be taking this much time. And the traffic in the Strait of Hormuz is 20% of what it was in January. And still, the market is at lifetime highs. If this frees up and some sort of resolution, even if it's a war that just finally cripples Iran and says, nope, we have control of the strait and we're never giving it back, that 9,000 target in the S&P is definitely possible, okay? So it's effectively closed, like 5 to 8 ships a day, 65 ships trapped. You're paying a premium to get through. Lloyd's of London, their insurance is skyrocketing. I mean, it's a mess, all right? 20% of the world's oil is going through there. Hey, John, good to see you. The market is figuring out alternative oil routes. That's exactly right. And they're going the long way, or they're shipping by truck, or they've got pipelines that they're activating. That's exactly right, John. So 64 violent incidents and 17 deaths involving commercial shipping since February. That's like 17 plus too many. And again, Lloyd's of London calling the strait open but volatile. What that means for them is there's going to be a big surcharge in premium. And since the U.S. is guarding it, we think that it's really easy money for us. Watch for a banner year for Lloyd's of London. If you guys don't know, that's a private insurance company based out of, you guessed it, London. So that's why this piece isn't priced as peace. The physical choke point remains a war zone with a press release that could change at any time. So the oil's war premium persists. Brent crude at $87 today. West Texas Intermediate at $81. Most of you just think about crude oil that, it's here from America, which is West Texas. That's where it's mostly refined and stored in Cushing, Oklahoma. But Brent, and they often call it Brent North Sea oil, really is the world standard. And it trades on the Moscow Exchange and the London International Futures Exchange. But it's priced at a risk premium, thinking that this is not going to stop anytime soon. That's why gasoline is above $4. Those of us that put premium in our cars, it's at $5.50 around here in the suburbs of Chicago. So on the right-hand side, a deal's either going to get signed and it's going to be real, or it's going to collapse again. And here we go. But at this point, it just seems like the crying wolf. The market just doesn't care, or the earnings are just offsetting it because they're so strong. Now we get to October, second week of October, the banks report on second quarter earnings, right? All right. So third quarter earnings, I should say. And then it'll be interesting to see what happens. The third quarter, probably with inflation, usually the slowest quarter because people are on vacation. They're spending money there, but they're not spending it on holidays. Fourth quarter, of course, we report that in January with holiday spending. But it's just, you can't expect a whole lot of progress unless this war gets solved. It's just got to get done. So energy has been the quiet leader. Now, we've had positions in XLE, which is a basket of energy stocks. We're out of it now because it just got too frothy. And it's also really volatile. And we can get the same kinds of returns in other assets. I'm not saying we won't go back into it, but for right now, Exxon beat, Chevron beat, Conoco beat. And it's because they're obviously jacking up prices and getting away with it because they have a risk factor built in and they want to get paid for that. So energy is the market's built-in war hedge. It always has been this way. Those of you remember back in 1990 with Kuwait and Iraq and the US and George Bush and all of that, George Bush the senior. Nothing's really changed. Crude oil is the world's currency for hedging in wartime conditions. So this energy CPI Fed loop is the axis of this market, and every Hormuz headline moves the pump, the print, and the September odds of a rate increase. We really don't want that, guys. If you're a praying person or you're just a thinking person, you got to try to get a message in your mind to Kevin Warsh. Do not raise interest rates because nobody raises it just a quarter. It'll be a quarter in September and then October and then again in December. Just not what we want. All right. So tariffs, the same wall, but a new law. July 24, Section 122. And you guys are aware of this, that Trump has really wiggled around here. When those expired, he brought in Section 301, which is a replacement basically on the same day. And then the pharma wild card fired, 100% Section 232. It's not important that you remember all these sections, but the point is we're going to have tariffs as long as this man is president. He really doesn't care if the judges rule against it or the Supreme Court because there are different ways around it. And I think previous administrations knew that this could happen too. So they just created all these different backup rules or backup sections of the law code to be able to implement these. So the pattern continues to hold. Courts strike down one authority and another one appears. The wall stays, the paperwork changes, and that's it. So don't expect that to really change going forward, at least till the end of this term. But again, the market doesn't care. Remember in April of last year, when the tariffs first happened, we had a 20% move down in 8 days. So it became a bear market for 36 hours. And so the market realized, hey, this is crazy. The earnings are good. We're not going to let tariffs scare us out of here. We're buying again. All right. So it's going to happen this time too. All right, I'm going to rest my voice for just a little bit here. Any questions? Anybody in there? Remember, there's a 25-second delay. There's a lot going on, huh? I think that alternative route is, I need to cover that, John. I think that's a great idea. And I'll get a map out of here in the September show, depending on if we've got the strait opened up. If not, then yeah, we're going to need to see what these alternative routes are that these countries are taking. All right, so the employment scenario, many of you know the reason we do the show on the second Thursday of the month is because the first Friday, a week ago tomorrow, is when non-farms payroll is issued, and that affects everything about what we are doing. All right, payrolls went negative. All right, don't let that scare you. Remember, it's not payrolls going negative that can hint of a recession. It is GDP going negative. All right, so payrolls negative, minus 23. Folks, that's a rounding error. We're a country with 286 million people working out of 340. There should be more working, frankly. All right, but the unemployment rate actually ticked down. Wages rose 3.2. The participation rate, 61.4, and that is basically measuring people who are working part-time but would like to work full-time. So those are not full-time employed folks. All right, trailing 6-month average, just about 34,000 a month. The key data here on the next screen is that there were revisions. On the right-hand side, you can see that May was revised downward from 129 to only 63 positive, and June revised 57 down to 20. So whenever non-farm payrolls is issued and this is good to know about. You don't have to study this like I do, but it's good to know about. They're always 3 months in play. So next month, they're going to issue the August non-farms payroll on the first Friday of September. But they're also going to go back and revise, not May, but June and July, because the people that are trying to, understand growth in the employment sector, which is the most important sector out there, or certainly datum out there, want to see how this is changing. And because there's so much data to gather, you can't just get it all in a week. Obviously, it's the first, Friday of the month. So they go back and revise the previous two based on extensive data. All right. We saw growth in healthcare, local government education dropped, retail trade. These are small numbers, folks. It's just not. So hiring has really stalled. It certainly has not collapsed with a down 23,000. But every revision point is the same direction. That's what I didn't like about this. Minus 22 in the front month, and then May and June revised down. We will track that, of course, on the first Friday of September and bring it to you on the second Thursday of September. Okay. So what happens when jobs are weak is usually bonds. People buy bonds for safety, which drives yields down, but that didn't happen this time. All right. So people are selling bonds and the yields are going up. And if you have a home mortgage on a variable rate, that's not going to make you happy. All right. The bond market is fixated on inflation and not growth. And that is interesting because the bond market is larger than the stock market. It's enormous. And the foreign exchange market, currencies are even larger, but I digress. The point is that the bond market and the stock market's opinion of where inflation is going is bifurcated right now. Why does that matter? Because bonds going up in price is good. Yields go down. We see all of our interest rates lower, and that's a good thing. But weak data is no longer buying you a rescue from the Fed. The Fed is not your friend right now. They weren't under Jay Powell, and I don't know, but they're going to be under Kevin Warsh. All right. No new highs, and that combination is not a good thing. That's why our discipline matters more than being right. We stick on the right side of the trade, even though it's just a little kludgy here with this bifurcation between bonds and the job market. All right. The Fed is leaning towards a hike. I mentioned that earlier. The July 28, 29 meeting, they held it, but on a 9-3 vote. That's the most dissents in a decade. 3 dissenters that said, we need to hike. What is wrong with you boneheads? We need to hike. And Kevin Warsh is saying, yeah, sure, I'm going to hike on my very first meeting as Fed chair when Donald Trump vetted me from like 14 other candidates. No, not going to do that. All right. The committee will deliver price stability. All right. Well, things are pretty stable. All right. I give you that. But, we got a target of 2.0 and you're not there. So September 15th now is a genuine coin flip. The odds were 70% post the meeting. In other words, right after that July 29 meeting, and then dropped to 40% after the jobs missed. That was last Friday. We just talked about that, and have crept back up to 51% into CPI. And we will see now how the market reacts tomorrow. We had PPI today, CPI yesterday, and usually a couple days when they simmer on that data, they have a, reaction, and we'll see. We will just see what the market does. I wish I could be more profound than that, but really there are too many participants to try to guess what they're going to do. I still think inflation is a factor, but earnings dwarfs everything. You just have to realize that. That's why we focus so much on earnings here. Before I finish this tech section, though, I do want to just touch on inflation because a lot of people ask us about this. What is the Fed so concerned about? Well, the CPI number actually cooled a little bit. It was supposed to be a 3.5 and it came in at 3.4. That's a tiny percentage change. I understand that. But May was 4.2. Yeah, and Trump was not happy about that. And then he goes around saying, the agencies are crooked. Yeah, but when they rated 3.3, then you'd off them, right? So, but I digress. All right. The truth is a 0.1 gain, or in this case, you want a low score. This is like golf. CPI and PPI are like golf. Low score wins, okay? But the catch is that July's oil spike hasn't fully reached the index pump yet. I mentioned here in Chicago, premium is at 540. I think I paid the last time. That's a lot. I mean, it gets to $100 on a decent sized car. We have old SUVs that we really like, but it's a lot to fill them. It really is. So the war has not reached this price index yet, and I think it eventually will. So we had a spike in May. It dropped in June. It dropped just a little bit in July. It'll be really interesting to see what August looks like because that is the biggest or the bigger of the two vacation months, June, July, and August. I guess you figure July and August are the primary two. But it's usually August where you see that bump higher because gasoline, there you're out there on the highway and you can't really get mad because you got to have gasoline to power your car to get to the next city. All right, so what happens in August? We'll know when we do our September report for you. But the core rate keeps behaving 2.5%. The Fed wants this at 2.0. It's at a cycle low. It's definitely down from May's, but it's still not where the Fed wants it to be. So Wednesday's print, that's the CPI. It was hot, but it came in line a little bit, hot down from where it needs to be at 2.0. But the verdict came in at 3.4, right on the nose, and a little bit cooler on the previous month. So just like non-farm payroll, the CPI and PPI does look back 2 months, again, to get the most accurate data so people can forecast how they want to hedge inflation risk. All right, a lot of that's the bond market. The S&P futures actually firmed, and I like seeing that yesterday, and then eased when the tape looked like it was going to melt up again. Again, the market participants are just enjoying this melt up, and we had a lifetime high yesterday. We had one today. Even though the market's closing off its high, there are definitely buyers that just are believing in their hearts, I think. I haven't actually checked their hearts. That we are going to get past this war challenge and things are going to be great in the market. That's what I'm seeing. All right. So the PPI today recorded flat. We got two cool prints in 2 days. You can see that in green. Now what happens in Jackson Hole? Anybody know where Jackson Hole is? It's in Wyoming. It's maybe the most famous city like for the last 50 years in Wyoming because that's where the Federal Reserve goes. I don't even know how they all get into that airport, but somehow they do. It's the wealthiest city in Wyoming, and it's the smallest state population-wise in the Union. But they go out there and hang out for 4 days and pontificate on where they think interest rates should go and what their role is in providing employment opportunity and keeping inflation under control. Remember, the Fed has a dual mandate: maximum employment, minimum inflation. All right, that makes sense. So our read is, I don't want to bet the book on one print, but we do respect that the Fed wants to see it deliver. All right. PPI today, it was kind of cool, as I mentioned earlier. That's good. That's why it's all in green here. Two cool prints in 1 day. We want to see that. Let's see if we can have August not drive prices up. Energy, as you know, is the biggest the biggest addition to CPI, Consumer Price Index. So energy prices always at the top of the list, unless every once in a while it's healthcare like during COVID, but certainly energy most of the time. And if we have a bump there, then it's not going to be a pretty report when we have CPI and PPI reported in September for August. So the one tape is the market's right at lifetime highs, crude oil's down, and that's West Texas. That's our crude oil, okay? And it's a whatphoria on the screen. That's why I came up with that new word. It's just hard to believe. I don't know what phoria this market is, just keep going higher, and especially when the Fed splits. I mean, that means we've got some acrimony at the table in there. When 3 people go against the chairman, and it happened with Jay Powell, there were 2, now 3 with Kevin Warsh, you get something like a 7-5 split, and it's just really going to get ugly in that room. Look like the signing of the Declaration of Independence or something. But at any rate, that's where we have it, folks. Let's talk about our 2 programs here as we wind down the second half of the show. DS and MP basically created one a year ago, one 7 years ago, for one extreme growth, I would say aggressive growth, and then DP, market proxy, I should say, not DP, MP, too many acronyms, to try to gather basically the market performance, but with some downside protection. And it has worked that way so far. Through July, MP is actually outperforming the S&P by a few basis points, but in the downturn, it was down less than the S&P, and that's what people want to see. So it's rule-based. You know about our 3-channel system. We've used that now for several years, actually many years. And it's the aggressive growth. Okay, it's the aggressive growth engine. This is DS. Started in 2017. The full performance is on the website. You just go to cb3financial.com/performance. There's actually a button. You can just click the word performance. The nitrogen risk, those of you that follow your nitrogen score, it's an 88. So each of you has a nitrogen score for you as a couple or individual, if you're a client that's not married, and you'll see that your individual score, we try to match that as closely as we can to the nitrogen score of the portfolios or the portfolio mix that you have. And that's what we do. That's part of what we do on the, not the asset management side, but on the financial planning side. So it's built for investors comfortable with volatility for high growth potential. We do have the options hedging in here. It has outperformed the S&P since inception. All right, the annualized return for DS, 21.8 against 15.1 for the S&P. Volatility, it is more volatile and it has had a bigger drawdown. And the beta is higher, but of course it would have to be more successful than the S&P because it takes more risk. But again, since the last year or so, we have added this QQQ options put spread, which during these spike downs, we believe will offset risk, especially like a 2022 where the NASDAQ was down like 40% in 3 months. So, and it recovered completely from that, as did DS at the time. All right. But it's a little more, I guess, a peace of mind if you see that the options kicking in and the drawdowns aren't quite so bad. So inside the book, what do we have? We have the mega cap platforms. Okay, so these are the 7 Mag 7 stocks. They are the predominant core holdings, if you will. We have AI Semiconductors and NVIDIA and Broadcom. Quantum is the ETF that we use, which has an aggregate of the most important quantum computing stocks. Broadtech, QQQ, of course, Space and Frontier with SpaceX, and obviously there's the hedge that I mentioned and the cash. So routine drift restoration is what we did last month. That's all we did because all the stocks were performing well, and stocks that are performing really well, and you've seen this in years past, but I haven't talked about it recently. You always want to buy low and sell high, but sometimes if a stock does really well, you sell it when it's high back to its target. So let's say I want to have a 4% position in Broadcom, ticker symbol AVGO, and it just has a phenomenal earnings report, and it, all of a sudden it's up at 5.25% in a month. Can those happen? Absolutely, and we see it all the time. All right, then we're going to sell that back down to 4%. What are we going to do? If we still like the stocks that are down some, like SpaceX that got beaten up, then we're going to put a little bit more there and still stay fully invested. But we are buying when stocks are lower and we're selling when stocks are higher and keeping it rebalanced to the target allocation. That was a lot of words. If it doesn't make sense, shoot me an email and I'll be glad to explain it to you. But that is how it works. Tesla was one of those stocks restored to its 6% floor, and then Tesla is just on fire right now. It's just really doing great. So that's why we use that strategy. So MP is the market proxy core, just began a year ago. So happy birthday to MP. It's primarily ETF based right now. It's solely ETF based. We're trying to capture the market, which is about a 72 risk. We're at 70 even on market proxy. All right. The yield is 2.4. So for those of you that were in GI, this is what you got moved to. And for those of you that are really conservative, just a handful of you that have a very, very low nitrogen score, and there's nothing wrong with that. If that's where you're comfortable, we can accommodate you. We do have the S&P 500 put spread indexes in there. So when the market downturns, even though we have fixed income in MP, you will have that extra protection with the options hedge if you are in MP. So it's built to track the broad market closely at a materially lower risk. And all you have to do is look at the performance on the website and you will see that. So it's near the market with lower risk. We're a trailing return of 16.85%. That is not year to date. It's 1 year trailing since we began. Okay. The S&P was down in July. We were actually slightly up 0.68. And that's just the way it works out. We've had 91% of the months traded are positive. We have a positive Sharpe ratio versus 0.77 for the S&P, and the beta is less. So it's about 3/4. And it's again because we have some interesting selections in there, and we do change those weightings depending on what is happening in the market sectors around the world and here in the US. That's what you're paying us to do, is to reweight that to give you the strongest market performance to match the indices with less risk, with less volatility. And that's what this program does. So inside the model, US broad market, US low cap value, large cap value. Let's try this again. Broad market, 82%, large cap value at 18%, international developed market. So we're not doing anything in the emerging markets in this program because it's a more conservative program. We do have stocks from time to time that are riskier overseas stocks in DS. But here, international developed markets, the equity income portion is actually covered call selling. All right. And then small cap value, short-term bonds. It's important to know that when I say short-term, that means not treasury bonds. So these are short-term as in 3 to 5 years. We don't want to take duration risk again because the bond market has just been fairly unpredictable lately. Lately meaning the last several years, because duration risk is just coming at a huge price and we don't want to pay up for that. So we can still get you a decent fixed amount of income in these short-term bonds. All right, so the August 3rd rebalance was routine. It was just a retargeting. No fixed income was added. And again, we do have that put debit spread cushion. If you're interested in that and you want to know how you're aligned, if you haven't looked in your portfolio, give us a call and we'll let you know. The insurance is for your portfolio, the SPY put spread. I've talked about this all the way back to September of last year or October. Spent a lot of time on it. What happens is in a calm or rising market, the position just sits there and it does lose a little bit of value every day. But if a sharp decline happens, it helps to offset that decline. Think of it as driving with your foot on the gas pedal, one foot, your right foot, and your left foot on the brake. You don't have to reach for the brake. You're right there ready to go in a downturn. And as the downturn increases, like it did in March of this year, the options actually increase in value rather than going into the Greeks of the gamma and the vega expanding, as well as the delta expanding in your favor. I will not do that other than to say what I just did. Okay, but if you'd like a fuller explanation, there is a video on the site talking about that. And if you want it one-on-one from me, I'm happy to talk to you too. Okay. All right, questions coming in. Tesla is on fire. I hope not. Well, I know, Doc, you're not a huge fan of Tesla, but the price is doing very, very well. But yes, I realized that when I said it's on fire and they were burning so many Teslas just a few months ago, it was a bad choice of words. Thanks for catching me on that, Doc. Nellie, how are you? Glad to have you. Better late than never. And you can always wind back and watch the beginning of the show. So, all right, so this is how they fit together. We have the DS engine, which is growth, AI, Mag 7, quantum computing. There's higher volatility and deeper drawdowns, although we do have the options hedging, and that's by design. Where growth is meant to come from, that's the way it works. And MP, we want the broadest market exposure at 70% of its risk. You've already seen much earlier in this program and in previous programs, it's really difficult to pick what few stocks are going to keep up with the index. So we mostly trade the index with the downside protection, with international exposure, with covered call exposure, because it gives us income in those covered calls, which adds to the short-term bond income. But yet we're still beating the S&P even with all those add-ons, okay? So it's a cool portfolio. It really is, all right? And most clients are going to have both of these. The smaller clients don't necessarily have both, and they're mostly going to be an MP. But if you're concerned or interested to know more about how you're allocated, give me a call or shoot me an email, cb3@cb3.com, and I will talk to you about it. And we'll make sure that you are on target with your financial goals. Guys, that's it for an August show, the heat wave show, the August melt up show. It's just crazy what the market is doing, but it's crazy good. You should see good results in your portfolios, and I'm expecting that to continue for at least the next few weeks. September, I don't know. It'll be September 10th. We'll know a lot more about non-farm payroll, CPI, PPI. All of that happens before that show. All right, on deck, the FOMC preview, Hiker Hole, Jackson Hole in late August. It's always something going on to talk to you guys about. All right. If you are new to the program, please do subscribe to us on YouTube. Click the little bell and you'll get updated when we go live. You can follow me on Facebook, on Twitter, which is X, of course, and LinkedIn, and our podcasts. Try to do those every week. I don't always get to it, but I try to. So you have 3 ways to follow us: on the monthly show, which you're watching, the weekly podcast, and my tweets every single day, sometimes multiple times a day. And a couple quotes here I just like to leave with you, and you feel free to type in the chat. Again, if you have a last question before we sign off, it's about a 25-second delay, so start typing now. Bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. Or they die on whatphoria? Sir John Templeton and CB3. We don't trade euphoria or whatphoria, we measure it. The plans of the diligent lead surely to abundance, but everyone who is hasty only comes only to poverty. We are not hasty. I have been accused sometimes of reacting more slowly to trends than some clients would like me to, and I just realized that at this age of all of us pretty much watching this show, we need to be very prudent about making fast asset allocation changes in a roaring market. And we have pretty much a roaring market right now, but again, we do have our fixed income in place in MP, and we have our QQQ option spreads in TS. So we are prepared for a downturn. Doesn't mean we won't have pullbacks and losses, or at least open paper position profit losses. All right. So just hang in there. It makes sense that we stick on the route that we are. We don't know where the top is. All right. And I always close with, for we have not been given a spirit of fear, but a spirit of power, love, and a sound mind. All right. John, thanks for the compliment there. You guys, appreciate you watching this every month. I hope you've had a good summer. We've lost power a couple times here, maybe 3 times here. Chicagoland has really been hit with some vicious storms. I hope you have not been wherever you are. Or if you have, it got turned on pretty quickly. We had to throw out about $400 worth of fish and pork and all kinds of stuff in our freezer. Just couldn't make it the 49 hours or whatever it was before we got power back on. So hope that didn't happen to you. But enjoy the rest of your summer. We will be back in mid-September with everything I just mentioned. We so appreciate you being here at CB3 Financial. We don't just manage your assets, we become one of them. And you guys truly are our friends and our greatest asset. We are here to serve you any way we can. Hang in there. We will see you next month.